says some bullshit and the market runs around all over the place. Team, we have the FOMC rate decision and the report coming out in about 15 minutes here at 2 p.m., followed by Jerome Powell speaking at 2:30 p.m. So that's what we're going to be looking for here. It's going to be interesting. We've seen the market kind of chop around all over the place today. Exactly what I was telling you guys was going to happen in the pre-market. There was, honestly, if you didn't do anything today, you probably beat like 90% of traders out there that are trying to be like, oh my God, it's Powell day. I'm going to try to do all sorts of nonsense. Relax, wait for the opportunities to come present themselves to you. And you guys are going to be just fine. But team, make sure you guys hit that like button on the way in. I'm late. How the fuck am I late, bro? How am I late? How does that make any sense? The stream started at 1:45 and it's 1:45 right now. What is this nonsense? All right, guys, keep smacking that like on the way in. Let's do it. We're going to have some fun today, huh? We're going to have some fun with Powell, huh? Let's do it, man. All right. Where's AMD? Chop it around. We got all sorts of nonsense happening over here. Rivian looking interesting. Rivi looks interesting. I mean, this was one of the ones on the swing list from this week from you guys. And if we go back to Monday, look what happened. Bink. Wait, no, that's Friday. Bink. Rip. Bink, 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 bink. Cruising on Rivi. So it's just a waiting game, guys, over the next 14 minutes here to see what we're going to get. Keep smacking that like button on the way in. A little testy today. You're just spewing nonsense. FOMC is like planning earnings on a ticker. Size smaller, stay away. 100%. 100%, man. Yeah, and remember, you guys have seen, if you guys were on the morning stream, what's his name? Faust Josue is up over 300K now with us. I mean, you guys saw the interview. It's out on the channel right now. That was when he was up about $100,000. Dude just got his payout. Absolutely killing it. Again, I don't know what else to tell you at this point, man. You guys can keep being lazy, not making money in the market, or you can come to the best place to learn to trade. That's why we're giving you guys a month free. Let's see. A wizard is never early, never late. Always arrives. What is this? Fucking Harry Potter? Bro, I should fucking call myself that. I always say I'm doing wizard shit. I should call myself the Harry Potter of the stock market and just... I mean, it feels that way sometimes when I give you guys like fucking 300% swing trades back to back to back to back to back. Like, come on now. All right, Spy's chopping around, not doing much here. Let's see what we're going to get. Gandalf? Isn't that from like a completely different thing? Holy slacking on the like button. Holy shit. Slackers. All right. Yeah, so we're going to get a 25 basis point rate hike. If for some reason we don't, the market's going to move big. So we'll see what we get. Then the comments from Powell are going to be the most important. And then we'll see. This is also what we have to look out for here. Right now, there's a 56% probability that we end the year with a target rate between 525 and 550 basis points, meaning that the market in general right now has an over 50% chance or is projecting with an over 50% probability that this rate hike that we're going to be getting in 12 minutes is the last one of the year. So we're going to have to wait and see how those probabilities change after this comes out and the statements from Powell. How's the 1348 crew doing? Absolutely fucking epic, bro. You guys see those interviews? Like, oh, we have 19-year-olds making $300,000 in a month. Crazy, dude. Right before I didn't see that. Feels good that Josue is your little brother who trades upstairs and I trade downstairs. You're working out some funded accounts too. Atta boy, D-boy. Yeah, you guys are crushing it, man. You guys are crushing it. But yeah, everybody gets their first month free. Make sure you guys are taking advantage of that before we pull that away, because that's happening soon. You guys have had enough time. Let's see. Tessie, AMD, is NVIDIA starting to cruise here? Yeah, a little bit. T-Doc was a good one. Nice. There you go. I haven't seen it. I mean, I was sort of on my radar for a bit, and then I was like, nah, I mean, let me take a bit. Yeah, wow. Was this earnings? No, that's earnings, bro. That doesn't really count. Oh, I gambled on earnings. Woohoo. Yeah, I mean, good play, but, that doesn't count. That's a gamble. Let's see. Where's, Microsoft? I have an alert on TLT to see if it's going to crack below 100 again, but, yeah, no. Maybe after this. You have your mocha in hand ready to take a trade once you see the clear direction from Powell. I'm probably not doing shit, honestly. Why? I mean, I don't really see any reason to do all that much. Rivy flashing around, doing its thing up in here. SPY moving a little bit. All right, guys, 10-minute countdown. Here we go. 10-minute countdown. Here we go. Let's see. You gave me the news. Let's see. Let me see. Oh, that's interesting. That's very interesting. All right. Well, we'll see about that. That's fun. All right, team. All right. Yeah, 9 minutes to go. Here we go. What do you guys think Powell is going to do? What do you think he's going to say? Do you think he's going to be fuck your puts Powell? Or is he going to be full-blooded just money printer Powell? Am I straddling Powell? Well, it wouldn't be a straddle. It would be a strangle. And no. Straddles are different than strangles. Straddle you probably would not want to do. You probably wouldn't want to do either with the premiums this high. But, I mean, you can do what you want. I would not do either. He's going to be a hawk and get the market down. Well, fucking do it. Give me better opportunities for swing entries. I've told you guys, I don't like buying calls with the SPY above 450. It just feels weird. I don't like doing it. It works. Like we've still been slaughtering it, but like, I just don't like it. 25 basis points today with a hawkish outlook. I mean, we could easily see that. Let's see. You ready for whatever? Nice. Nice. Oh, wow. Hold on. JP Morgan to buy almost $2 billion of mortgages in the Pac West deal. It's not moving off of that. I mean, it's already up, but that's interesting. All right, what do we got here? You just hit the like button twice. Thank you, winning loser. I appreciate that, buddy. Yeah, guys, keep smacking that on the way in. Spread this stream out. I mean, there's going to be a lot of morons streaming today that are like, oh, I think I know what Powell means. No, they have no fucking clue. Let's see what we get. TLT, little nosedive is expected. You'll take your 10%. Thank you. Attaboy, Wreck-It Ralph. Yeah, we'll see. I mean, if TLT gets back sub 100, I'll take a look again, but we'll see what happens. Yeah, the JP Morgan news is really all I see. Six minutes. Here we go. You're probably not trading today. Smart. Doesn't make sense to. Why would you? Premiums are high. It's chopping around. It's not doing anything. Like, why trade Powell? It's just a gamble. You're literally just gambling. I mean, I did a whole rant in the pre-market for you guys this morning about patience and waiting and making sure you're not doing anything stupid. You can either listen or not. I mean, I feel like some of you guys just are like, you like make it a point to not listen. Like, I show you guys, like, oh, yeah, what's his name? Like, 19 years old, made 300K in a month. You guys are like, nope. I'm just like, all right. Pay attention or pay a premium, guys. And it's going to be rough for some of you that aren't paying attention. All right. You're just so antsy. You're like, I want to take a trade. It's like, fucking chill out, bro. What's up with Tup? I don't know. It ripped yesterday on earnings, I think. It's ripping again today. Is it? No, this wasn't today. When was the top pump? It was here, I think. Friday. Oh no, it was Monday. That's when it was. Penny stock. I don't like penny stocks, so I mean, you guys can gamble your money on those if you want to, but not for me. Let's see. Let's see. When I say don't trade Powell, and then I do, well, I also know what the fuck I'm doing. Like the thing is most of the time, if I say don't do it, there's a good reason. If I decide to, it means that something looks so fucking good that I can't not. But I don't think I'm doing anything today on it. This I'm not doing. This this up here, I don't really want to screw around with. I honestly think it's going to be a dud. That's my expectation here. I actually think this is going to be a dud. We'll see, though. Unless he says... That's the problem, too. Here's something funny. Sometimes I feel like I know too much about the market because when I think things are wildly obvious and it's like, yeah, but they've already said that. And then people react to it again. I'm like, what? It doesn't make any sense, but like, I don't know. That's just the way the market works sometimes. So usually I sit these types of things out because it's just like, all right, well, we already know what's going to happen. And that type of information is going to help a lot more for setting up like swings versus a quick day trade. Will I be streaming Powell? Yeah, that's what we're here for. It's not like I'm literally just going to come on and cuck all of you. Like, just be like, all right, I'm going to come on for 2 minutes and then leave. Like, that's silly. Oh, hi, guys. Bye. Like, what the fuck is that? But yeah, make sure you guys are getting your free month. QR code's on the screen. Use code GAMES. You guys are good to go. Let's see. If you guys ask me when Powell is, I'm going to lose my mind. Will there be sound during the cover? What do you mean? You're going to be here. That would be funny, though. No, wouldn't that be a waste of fucking time? It literally says Jerome Powell live in the title. That would be the biggest, like, switcheroo ever. If I'm just like, oh, yeah, fuck you. Like, no. But yeah, also make sure that you guys are following me on Instagram. I know a lot of you really enjoyed the type of video that I posted yesterday, and I have another one that I think is even funnier that's going to go out after hours today. So make sure you guys are following me over there. It's just short to VIX1. I feel like every FOMC meeting, Powell says something bullish, then bearish, then bullish, then bearish. Yeah, exactly. There's no way to be consistent during an FOMC meeting. Exactly. That's why you don't fucking trade it. Like, if you do, you're just gambling. And if you decide to trade it, I mean, go for it. But like, just like relax. Don't do it. Why would you size like crazy? That would be insanity. Hey, SB, what's up? Not much, man. Excited for Powell. You're not trading. Just curious to see what the charts do. Yeah, I mean, I'm interested in it. Oh, we are 22 likes away from 100. Thank you, team. Keep smacking that like button on the way in. Most analysts expect the Federal Reserve to raise the federal funds rate, federal funds rate target range by 25 percentage points. That's 0.25 percentage points. Yeah, fair. All right. Sorry. I thought they were being stupid. In a unanimous decision. That makes sense because that's exactly what the market's pricing in. What else we got? Oh, analyst. Federal Reserve Chair Jerome Powell is likely to avoid declaring an end to the rate hiking cycle. Oh, all right. Okay, you guys want to know what's about to happen? Most likely. All right, here's what's most... That was big death. Here we go. All right, 2 p.m. Ooh. Hello. All right, so here's what's most likely what Powell's going to do. He's going to leave the door open for more rate increases, but then probably not do them. So, yeah, so there's that. There's that 25 basis point hike. We just got it. We're popping off of it here. Hello, market. Let's see what we got. Let's see. The first candle is flashing around. I mean, this isn't quite a dud yet, but it's pretty close. TLT, what'd it do? Shot up. Okay. Okay. Yeah, I know so 25 basis points confirmed. I don't see any headlines though. I need more headlines. Yeah, that's it. I'm just refreshing to see when we're going to get it. I just want more headlines. Here we go. FOMC voted 11-0 for federal funds action. Economic activity has been expanding at a moderate pace. Job gains have been robust in recent months. Unemployment rate has remained low. FOMC will continue to address additional information implications for monetary policy. It's exactly what we said was going to happen. They're going to do the 25. The market's going to flash around a little bit, and he's going to leave the door open for further rate increases and just fall back on data. But they're not going to declare an end. Fed move puts rates at a 20-year high. Yeah. But what they're not going to do is say that's it, because they don't know what's about to happen next. So they're going to leave the door open for more rate increases and just kind of let it go. You notice that the EMA is displayed differently in TradingView and Webull charts? Yeah. They've used TradingView. Use TradingView. Yeah. So this is just flashing around here. We got Powell in about 28 minutes. All right, hold on. What else we got here? Fed says it will continue to reduce its bond holdings as described in previously announced plans. So they're still trying to shrink the balance sheet, but that's kind of fake because they don't actually do that. Let's see here. Ooh, 8 likes away from 100. Thank you, team. Appreciate it. Yeah, what else we got? That's it so far. AMD and NVIDIA not doing really anything. This is a exact. I think it's gonna be a dud, especially until Powell speaks. Let's see. Let's see what else we got on the feed. I don't think there's gonna be much else. Ooh, there you go. Yeah, it makes a lot of sense. It makes a lot of sense for them to leave the door open. Because if they don't, the market just goes, whee! And it goes fucking crazy. And they don't want that. So they'll just delay until rate cuts. They'll say, I don't know. And then the market will call their bluff and do exactly what they just did and pump it regardless if they're going to do it. But it'll be a less strong pump if it's going to happen. Because there's still uncertainty. More robust CBO projections still show unemployment rising this year. CBO expects inflation to continue declining this year from the Wall Street Journal. U.S. economic growth will remain low for years. U.S. economy stronger this year than previously expected. That's good. Yeah, Ralph, I see it coming in. I have the feed open. Federal Reserve raised short-term interest rates. Yeah. The Federal Open Market Committee made few changes to its July policy statement. That's important. All right. Yeah, let me queue up the stream, the Powell stream here real quick. Jerome Powell. All right, let's see. Yeah, all right, guys. Oh wait, hold on. All right, let's see here. All right. 25 minutes to go until Powell. Market's not doing anything. As expected, we have a dud. Until Powell speaks, then it can start to pick a direction. But until then, it's probably going to be a dud. Fed swaps continue pricing in 50% likelihood of an additional hike. What does that tell us? Uncertainty. They are not picking a direction yet. So the bulls and bears can have their thesis here. What the fuck happened there? That's interesting. Yeah, that was what I was expecting. Just like you haven't, the only, like, it doesn't make any sense for it to go nuts off the interest rate decision. The only thing that it could move really crazily off of is what he says. That's it. That's really it. So again, our little rant this morning telling you guys to sit on your hands and probably don't do anything unless something looks wildly good because of X, Y, Z, ABC. Pretty spot on as usual, man. When the whole market is in agreement on a rate hike, it's a nothing burger is obvious. Right. Exactly. Exactly. All right. What's this? FOMC. Okay. That's just a link to the thing. I mean, let's throw this on the 5 minute. It's not really worth looking at it on the 3 if I'm not going to trade it. So you just wicked up to the 5 minute 200, then shot right back down. Nico, what up, buddy? I don't think Gabe is. I think Gabe's busy. Let's see. I am tired, bro. I am tired. Let's see. Where's Tessie? Just trying to move a little. Premiums are still going to be high. You've been redesigning a nightclub to launch? That's awesome. Amazon enters healthcare AI market. Interesting. Your personal playground. There you go. He said he might join. I haven't seen anything. He didn't text me. No, I got nothing. Let's see. All right. AMC, you're taking your put profits and leaving you alone for now. There you go. Yeah, I mean, you guys saw me drill AMC for like 30%. That piece of garbage. Let's see. I feel so bad for all those people that are still listening to that nonsense. After Ape, it was dead. Told you. There it is. It's still dead. But let's see. All right, we got 22 minutes to go. Let's see. Oh, it's back under 5. Answer, who actually runs the market? Nobody, bro. Nobody runs the market. The New York Stock Exchange runs the market. The NASDAQ runs the market. If you think there's somebody like, ooh, it's wrong. It's not how it works. Nobody's out to get you. And if you think like that, then you're going to lose all your money. Logan runs the market. Let's see. The market runs on Duncan. The lizard people. Let's see. Yeah, I'm very interested to see what Powell's remarks are going to be, but I kind of already know what he's going to fucking say. JV's getting scammed. JV, how much you make today? How much you make today? Was it a lot? Ooh, that's interesting. Let's see. 2.3% all I need? Fuck yeah, Jamie. There you go, buddy. Attaboy. I love scamming the shit out of you guys. You know who I scammed the most? Josue. You need 300K, bro. That's so epic. I love that shit. All right, let's see what we get, man. I mean, this thing's just going to be chopping around until Papa comes to meet us. Fuck your puts, fuck your calls. J Powell has you by the balls. All right, let's see. I don't know. I could post that Instagram thing right now. It's hilarious. I was thinking about making it yesterday, and I was like, dude, this is gonna be fun. Playing Puppet Master behind the curtains. Me? Bro, what are we glitching out for today? Restream. Why are you being an asshole? Ugh. Whoa. All right. MasterCard demand shutdown of cannabis buys on its debit cards. Bro, it's the fucking MasterCard. Chill out. Like, all right, here comes a little movement out of the SPY. Start a new 5K account to see if you can hit 1 million with it. The Tesla only a trade account paid for the Roadster in 4 months. Fuck yeah, guys. All right, let me just. That's wreck it, dude. That's epic. All right, I'm gonna throw the link in here for you guys once. Use code GAINS on the monthly plan, GAINZ, and you get access to your first month completely for free. Make sure you guys are taking advantage of that before it's too late. We've been talking about that for a while. That is just, you guys kill it, bro. You guys kill it. Yeah, and the QR code's on the screen too if you guys want to use that. All right. The first words out of what are the first words out of Powell's mouth going to be? It's aside from good afternoon, because that's always first. Oh, I'm tired. I need a nap. I got shit I got to do later. Can't even nap before that. It's not going to be ankles. Yeah, it's good afternoon. That's easy, though. That's an easy spot when he says good afternoon. Rivy little movement. SV, all I have to say is your thigh gap strategy freaking paid today with Amazon. Oh, get ready for what I'm about to show you fuckers in masterclass this weekend. I would have shown you guys it today, but we're streaming Powell right now, so we can't do that. But get ready with what I'm about to show you guys in masterclass this weekend for thigh gap reversals. You're literally, I've been looking at them today and all of this week and back testing like the last couple of months of data. It's you guys are good. You guys are gonna have some fun. I'll just tell you that. I've got a couple of fun things prepared for you guys with thigh gap. It's nasty. There's like one pre-qualifier to make your thigh gap trades on. Okay, well, I'm gonna preface this when we do talk about it, but there's one key thing you gotta look for, and if you do that and you do it properly, you're gonna have some fun. It was textbook 3 times. Yeah, dude, that's what it's there for. It's nasty. Congratulations, Morrow. I love it. I love to see you guys winning. All right, man. Let's see what we get. $25 basis points. Yep. It better be them ankles. Well, it's not. Good afternoon. Today we decided to raise the Fed funds rate 25 basis points and plan to wait for further data to determine September decision and any other rate increases. I don't think Gabe's popping on. I haven't seen anything. I haven't gotten a text or anything. He FaceTimed me, but like it was like mid live, so I couldn't answer it. Let's see. Everything just flying around waiting for Powell. I don't know where he is. Usually he comes on. Let's see. What do I think you will say? Give me a minute. I gotta think. Today we raised the federal funds rate by 25 basis points. Fuck, I forgot. Usually I'm good at these. My brain is just like not working right now. White House have seen reports of a second Russian aircraft flying dangerously close to a U.S. drone. Hey, whoever's fucking playing Call of Duty with drones out there, chill the fuck out. Oh, look at this. Look at this. Look at this. Look what the analysts are saying. Look what the analysts are saying. Ready? Ready? Analysts. Powell is keeping his options open for potential interest rate changes in September. The longer 8-week intermeeting period in the upcoming Jackson Hole conference will allow officials to gather more data and send a stronger message if needed. Hire me, Goldman. Fucking spot on every fucking time. Goldman needs to get their dumbass analysts under control, though. Fucking their price targets. They're stupid summer interns. Who the hell let one of the summer interns start ripping off price targets out there? Like, let's see. He's busy bending over Tesla. Hey, let him do his thing. Let's see. Can they fucking stop playing Call of Duty? Can they just like not do that? It's like they're F1 racing out there with drones. Stop. Spy. Patrick, that's what are you talking about? Let's just say spy target and then spam random sequences of numbers. That'll work. All right, guys, keep smacking that like on the way in. For those of you guys that haven't, we got over 100 of you guys slacking in here. I want to see at least 200. If you hit 500, it's a Powell day. I will do ankles. That is the one thing I will offer you today, besides the absolute gift of a free month on Trade 1348. If you hit 500 likes, I will do ankles. Which I feel like at this point the joke is dead, but I don't know. Let's see. Let's see how dead the joke actually is. Oh, fuck. Here come the likes, you assholes. You fuckers. You guys are so weird. You guys are so weird. If this hits 500 on the like button, I'm going to lose my mind. You guys are so strange. Ankles will never be dead. Well, okay. Let's see what we got here. Need more content for 1348 OnlyFans. Fuck, I hate you guys. You guys suck. You guys, every single time I say ankles, you guys are just like, it's weird. It's weird, bro. Rivian's selling. Rivian coming down. Uh-oh, Spaghetti-O on Rivi. Let's see. You came back just for ink. I can't believe you've done this. I can't believe you've done this. All right, let's see. We got 19 minutes. What's with the pearl necklace in my YouTube videos? You love it, don't you? You love the pearl necklace. Look, you love it, huh? Look at this. Look at that. Look at that pearl necklace. I might get another one. Rock 2 of them. Mm-hmm. Yeah, Rivi's slipping hard here. Rivi coming down hard. Let's see what it wants to do. Whose wife did I steal these from? Put the pearls around my ankles? No. No. Leave me alone. I'm not a piece of meat. But if any of your wives ask, I am. Okay. Next. Next. All right, let's see. Make my eyes bling too. Yeah, I think I know what you're talking about there. I don't want any of that. It better be both ankles. I'm tired of seeing one. Well, if you hit 500, I'll do both. AMD. Yeah, guys, this is just gonna fuck around for the next 10 minutes until Papa comes out. Next. Is Mikey still around? I don't know, man. He's probably got lost behind Wendy's. Bro, I'm so tired. More energy. All right. Yeah, no video today, too. We're doing 2 streams, so no video. Tomorrow, though. Why is my whole thing glitching out today? It's Powell time. This is not okay. The audio is always fine, though, which is really all we need. Those midday streams were dope. Yeah, but we didn't fucking do anything. It was just us fucking around. That's why we stopped it. There was nothing happening in the market. Did we just be like, all right, we're going left? Like, we're not doing that anymore. Like, you most likely have gotten a job or a girlfriend? Maybe. Maybe. All right, we're 21 likes away from 150. You guys are getting there. You're not going to get it, but that's fine. You guys just don't want ankles as bad. That's cool. Do I also sponsor Bud Light? Fuck no. Let's see. Go woke, go broke. All right, let's see. Let's see. 8 minutes. Here we go. Yeah, we got the stream on. We're going to have to mess around with the audio for like 2 seconds when it comes out, which is fine. We always have to do that so that you guys can hear it, and then we'll be good to go. Need more. Maybe I'm just dehydrated. It's been hot today. It's been a bit steamy. Rivy did not like that. All right, man. It's just a waiting game. You had to log into your second account to smash the like button a second time. Thank you, Nature's Barista. I appreciate that, buddy. I mean, again, you guys just are just trying to rip ankles over here, I guess. I guess that is what it is. All right, AMD chilling here. Nancy chilling on top of its 3 minute. Tessie slippage. Spy fucking around. It was your fault you stopped the midday streams? No, it wasn't. We just were like, all right, well, we're not like, what are we doing here? Market's not moving. We're just fucking around. It was wasting of everybody's time. Let's see. What the? Fuck it. Stay hydrated. I got liquid IV somewhere. I just got to grab it when I'm ready. You know? We just got to see what Papa's going to bring us. We got 6 minutes. All right. It is currently a dud as predicted. Let's see. Yeah. Dude, it is so hot in Boston today. It's like 90 fucking degrees. It's insanity. Half of you slackers have hit the like buttons as Daily Taylor. Yeah, what's up with that, guys? Slackers. All right, let's get after it. Oh, it's losing it. It literally just is like right back to where it was within like $1. Like, it's not moving. 5 minutes. We need ankles. Look at the potassium sodium, maybe avocado. Yeah, I'll be fine. It's not like I'm gonna die. On YouTube Shorts. Dude, don't hate on my white Doc Marten boots. Those are fucking epic. Aries. Before you ask any other questions, one, it depends. And two, you gotta watch all of the learning curriculum videos. Me going back and forth with you answering these questions right now is basically like me trying to teach you how to trade just in a live chat. It's not going to work. You have to go through and put the time in this weekend and watch all of those learning curriculum videos and do exactly what I said earlier, paper trade, and then figure out what you like best. Spy slip in here. It's not going to be helpful for me to come in and say, because they're both nasty. Like, it's not like, I'm wearing earrings. Fuck no, not doing that. No, I'm not wearing earrings, bro. That's not happening. Sorry. Oh, you fucker. Okay. Leggings? You guys are literally suggesting things to wear that have the opposite effect of what the pearls do. Like, what is wrong with you? You guys are so strange. So strange, bro. So. I like that better. Let's see. We support you. Don't. If I ever start wearing leggings or wearing pearl earrings, don't support me. Literally leave. Don't support me. All right. We have 2 minutes to go until Papa. And I think I gotta do this. All right. And then we gotta mess around with the audio real quick, and then we'll be chilling. Yeah, literally. Like, if I start doing that shit, one, I've probably been like attacked or like injected with something. Or two, I don't know, something's gone terribly wrong. Something's gone wildly wrong. And I would expect you to not come hang around anymore. Let's see. I would say the Matrix got to him if he did. What does that shirt say? Negative influence? Yeah, only on myself, not others. All right, let's see. I don't know. I just found a random shirt today, and I was like, this is what we're going with. You guys are bugging. He's not wearing women's clothes or jewelry. Yeah, bro, that's not happening. All right, here we go. Let's get Papa on the screen. Here he is. Here we go. Let's get all this nonsense ready to go. That's not going to fly. All right, and then we got to do this audio. Then I think we do, I think we turn off that. Hold your horses. Where's Papa? Here he is. Hold on. My computer's losing its fucking mind.
And I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We're also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here we go.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warrant it. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina. Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but doing, performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS look good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So
He's trying to cuck you.
If you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter. That by September, that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. how much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, but what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3%?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3% or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs. Now we have some large labor settlements. Or is the economy disinflating and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend to, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think, today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down, the point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Howard.
Thanks. Howard Schneider with Reuters. So among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy. And there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags plural that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is the growth rates edging down towards and below, heading below zero, which is usually, a recession indicator.
So I guess the sluice will come out early next week. And I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. Tease out how much of that is from this source or that source. But I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this sluice will say.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing. And the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level, and not
the large amount of people.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Steve.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast as well as the individual participant forecast is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market. And that's a really good thing. I would just also say the historical records suggest that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions. And that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. And in fact, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Banc of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt? Or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point? And how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result tightening interest rate policy is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but important issue going forward. Labor markets broadly are going to be an important part of getting inflation back down. And that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel, transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle-class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done. And the record is clear that if we take too long, or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Urbanovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event, the market had assigned a roughly 99% probability to the rate move that you announced today. The decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, was there doubt? I would say there's a range of views on the committee. And when you see the minutes in 3 weeks, you'll see that there's a range of views about what we should do at this meeting and what we should do at the next meeting. And it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, but we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down. And in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing. And ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with, so if you think about both of them as normalization, imagine it's a world where things are okay and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So to continue it, you depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it.
Thanks. So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance or lack thereof right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it, with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
Thank you.
Thanks very much.
Hey, fuck off. All right. What's up, team? We're back. All right. So that's gonna wrap it up for us. Basically a nothing burger. Hold on, let me change the setting here. That is gonna be wrapping it up for us today. Again. Interesting day. Let's see what we get throughout the rest of this week. We'll see which direction the market really wants to pick. Other than that, guys, another good day. Got a lot of shit to do. Peace.